I'm joined now by James Demmert. He is Chief Investment Officer at Main Street Research, a different Main Street than at Disneyland, and he joins me here at the desk. And we've been talking about all the action going on, as you've been seeing in Anaheim. Obviously a lot of action happening down here on the floor, a lot of mouse ears getting ready. In terms of the futures, slightly higher open. Not a whole lot of action actually this week. Sort of a sluggish performance if you look at the week-to-date performance. But I was taking a look at your notes. You say new highs by the end of the year. So this is just kind of the calm before more of a rally?
Yeah, we're bullish. I know a lot of people are worried about the economy. Is the Fed going to go or they're not going to go? And I think investors, the message should be, what's going on with earnings?
Yeah.
And, how did we get from beginning of the year to here with that big decline and that big recovery? And I think what investors are missing, and I think they need to look through, is that earnings continue to be better than expected. Yesterday we had the banks, a lot of them this week, reporting really great numbers, particularly JP Morgan and Goldman Sachs. And then, you have this morning, as we will talk about being a foreign investor versus a U.S., Taiwan Semiconductor just blew out these really great numbers. So I think the market is sort of a calm above. Underneath, you're going to see some very strong earnings. And we think the market goes higher by the end of the year.
Where else do you draw your bullishness from outside of earnings? Because at the same time, there is quite a bit of uncertainty. I mentioned retail sales coming in better than expected, but there is still a big question mark about what's going to happen to this kind of slowing economy. We don't know what's happening with tariffs. So where else are you really drawing this bullishness from?
Well, you've got two camps of investors, and I think, there are two extremes, and I don't think either are right. One extreme is the economy's getting weak. Labor market might fall apart. The Fed's going to have to come. The other side is the economy's too strong. Inflation's too out of control. We have to keep a lid on it. And what I think is important that investors recognize that both can exist. The economy is in that sort of not too hot, not too cold, that Goldilocks economy. And I think that's what keeps the Fed on hold. So macro in the United States is an economy that faces headwinds from tariffs, headwinds from things such as DOGE and fiscal restraint. But also has the tailwinds of AI, the tailwinds of deregulation and tax cuts. So in our view, that not too hot, not too cold can be really great for U.S. stocks, and that's why we're bullish here in the U.S. as well as obviously outside the U.S.
So S&P 500 settled just below 6,300 at the close yesterday, right around near all-time highs. How much higher is the market going?
Yeah, Caroline, we've been saying 6,800, which was hard when the market was at 5,000 a couple months ago.
Yeah, sure.
But now it seems like, very possible. So we think 6,800 is certainly an easy target from here. Going to be led by earnings. I happen to think that a lot of these headwinds from tariffs are going to start to show up in the data, and the Fed will probably go in the fourth quarter. That gives us that one last boom up to that 6,800, 800 level that we see.
So that's one rate cut this year you're expecting?
Yeah, we think it's one, not more. And I think that investors should be careful about trying to price those in too often. That's where the market gets disappointed. But, in this case, the Fed really doesn't yet need to do anything. Earnings are good. Economy's resilient.
Okay, so investors should be careful about pricing in rate cuts. What should investors be doing with their money? Let's start here in the U.S. What sectors, what stocks do you still like, given the fact that we have seen this impressive 30% bounce from the lows?
I think investors get nervous that the market's all the way back to its highs. But keep in mind, most stocks in the U.S. are pretty much right where they were at the beginning of the year. But most earnings have gone up quite a bit since then, so price-earnings ratios have actually compressed. Stocks are at better value today than they were at the beginning of the year. In the U.S., you want to think about if there's headwinds from tariffs, stay away from tariff-related vulnerable companies. The U.S. is known for one thing, and I think that's not going to change for a while. We are the leaders in AI. So when it comes to tech and AI, you really want to focus there. And the other great theme in the U.S. is this deregulation of the financials. So we expect the big bull market in financials to continue through the rest of the year. So we're really focused on those two sectors in the U.S.
Tell me, what are some tariff vulnerable companies? Because based on last earnings season, we'll certainly see this earnings season because we're just kicking up. seems like every company has said that there's uncertainty about how tariffs will impact their companies. So just can you be a bit more specific about what tariff vulnerable companies
Yeah, the
look like?
vulnerability I would say is in the autos. Like a good example is Ford. And you look at the price of the stock and you see there's a lot priced into there that's troublesome. I think in the metals there's some trouble there. I do think, and our view is as a research firm, that tariffs will be lighter than they obviously were expected. So we'll have a little more certainty going forward. But there's a lot of companies that are immune to tariffs, and the financials are a good example of that.
Okay. And then you're not just looking for opportunity here in the U.S., you're also looking abroad. So talk to us about where specifically you're finding some investment ideas over there.
Yeah, at Main Street, we're a global advisor. We always have been, and this is a great time to be doing that. There's a lot of fiscal spending there and a lot easier money, sort of the U.S. playbook. And there you want to go to Siemens Energy, a company that is helping us build out the grid so we have more electricity to feed the AI and the EVs and the crypto. Companies like HSBC, based in London, there's easy money monetary policy there. Great for the financials. A company like Train Technologies, that's HVAC company that helps cool down processors as we continue to churn these servers away and all this crypto and AI. So there's a lot of great opportunities in Europe and outside of Europe, like in India. What's interesting, Caroline, is multiples. PE multiples are very, very compelling there compared to the U.S. And institutional investors really haven't gone yet, so we think this is a multi-year trend.
So value in Europe and still some opportunities here in the U.S., especially if you think that the S&P 500 is heading higher. James Demmert, really appreciate your picks and your insights. Thanks so much for joining me here at the desk. That's James Demmert of Main Street Research.